Hey everyone, welcome back to Corporate Decoder, the place where we read all those boring corporate reports so you don't have to. Today we're diving into the quarterly report of a company that wants to monitor your heartbeat from afar. Will they shock us with good news or will it be a flatline? Let's find out. This company called BIOTRICITY just released their numbers, and the headline is that while they're selling more, they're still losing money. We're going to break down what's really going on with their health, financially speaking. First things first, this is a Form 10Q, which is basically a quick checkup on a company's finances every 3 months. This one covers the period ending December 31st, 2024. It's not a full audit, but it gives us a good snapshot. BIOTRICITY is a Nevada company and they've been filing reports like this for a while. The key thing to know up front is as of February 18th, 2025, they had about 24.7 million shares of common stock out there and a little more when you add in something called exchangeable shares. That's how many pieces of the pie there are. Now let's get into the numbers. The report includes balance sheets, income statements, cash flow statements, the usual financial report stuff. Think of it like a doctor checking a patient vital signs. The balance sheet tells us what the company owns and what it owes. As of December 31st, 2024, BIOTRICITY had about $6 million in total assets. This includes cash, accounts receivable, which is money owed to them, and inventory, which is what they sell. But here's the kicker, they had nearly $36 million in total liabilities. That's way more debt than they have in assets. Most of their liabilities are what accountants call current liabilities, lies due within a year. This includes money they owe to suppliers and around $9.4 million in convertible notes payable and loans. These are short-term loans that can be converted into stock, which makes things even more complicated. They also have something called mezzanine equity, which is like a hybrid between debt and equity, around $2.1 million. And then there's a stockholders deficiency, this a negative number of around $32 million. That basically means the company owes more than it owns. This is because the company has lost money since it started, a big negative retained earnings. Moving on to the income statement, which shows how much money the company made and lost. For the 3 months ended December 31st, 2024, BIOTRICITY's revenue was $3.6 million. That's better than the $3.0 million they made in the same period last year. Their gross profit, which is revenue minus the direct costs of making the product, was $2.8 million. But then come the operating expenses, sales, administration, research, development. These expenses ate up most of the gross profit, leaving them with an operating loss. When you factor in interest payments, changes in the value of certain financial instruments, and some other items, they ended up with a net loss of $1.2 million for the quarter and $6.4 million for the 9 months ended December 31st, 2024. That translates to a loss of about 5.4 cents per share for the quarter. Keep in mind that there were way more shares outstanding this year than last year, which affects the per share loss calculation. It is important to note that this loss was before preferred stock dividends, which is essentially payments that they need to make out of the company's profits or equity that can not be attributed to common stockholders. This makes the loss attributable to common shareholders even worse. The cash flow statement shows how money moved in and out of the company. BIOTRICITY used about $2 million in operating activities. That means their core business operations are burning cash. They brought in around $1.8 million from financing activities, issuing stock and debt. Now, this section, mezzanine equity, that represents a particular type of preferred stock which can be converted into common stock, but also has certain redemption features. During the quarter, they converted some of this preferred stock into common shares, which changes the numbers a bit. Let's step back and look at some of the more qualitative stuff in the report. They are trying to sell devices and services for remote health monitoring. They are aiming for preventative care using existing markets and ways to get paid. However, here's a major red flag. The report says there is substantial doubt about Biotricity's ability to continue as a going concern. That means there's a real risk they might not be able to stay in business over the next year. They have a big negative accumulated deficit and more debts than assets. The numbers in this report are unaudited, meaning they haven't had a full independent check. The report makes it clear that these numbers might not be fully representative of how things will look at the end of the year. They did a reverse stock split, meaning they combined shares. This kind of move is done to raise the stock price but can be a signal of bigger issues. As a business decision, there is a focus on a high value to be earned on usage of the software, rather than merely selling devices. Interest payments continue to drag down the earnings, making it harder for the company to become profitable. They even had a gain to translation adjustment. That means they had profit on any activity or assets that occurred in the foreign countries. Some of the money they owe is to company execs, adding some pressure on their finances and raising potential conflict of interest questions. They have issued a lot of convertible notes, which means there is a real risk of diluting current stock owners. A derivative liability is something that gets its value from something else. These guys use complicated methods to evaluate the liability. The company leases office space. They're on the hook for over $1 million in lease payments. There are no big lawsuits hanging over their head. That's good news. After the quarter ended, they took on more debt and issued more shares. This means they're still struggling to stay afloat. Now, what does all this mean? Biotricity has a big challenge ahead. They are increasing revenue, they're not making enough money to cover their expenses and have a going concern warning. Plus, they have a lot of debt and complex financial instruments on their balance sheet. Based on the information in this report, Biotricity is in a tough spot. While there are some good aspects to their revenue growth, the liabilities and risks are concerning. Given the current financials and the going concern uncertainty, I'd rate Biotricity as a company that is trying to make progress but is very dangerous at the moment. A price range I would feel comfortable suggesting is at most 10 cents minus 0.20. This takes into account the debt and the going concern. I would have a selling bias. Thanks for watching. If you found this breakdown helpful, hit that like button and subscribe for more deep dives into the world of corporate finance. See you next time.